It's a snowy day in paradise. Yes, it is. Quite a change. I took pictures of the snow. It was so beautiful. The weather outside is frightful. Anyway, it's March the 1st, and we have the verdict on the median price house for February ended at $425,000. I hesitated just a second because it really is $424,925, but I rounded it up $75 to $425,000. And that is our new median price, down from $435, where we started January. So here we are. And there's a lot of things going on in this shifting market. The rents right now are lower than mortgages. So that's going to definitely impact everything. And I'm going to plug in my microphone quickly here so we don't sound so tinny. All right, here we go. So we have 75 days of inventory. So our days of inventory are slowing down, getting less and less. Now, a normal market is 6 months of inventory, and that's because why they call it normal is because that means the buyers and the sellers are equal to each other. Nobody has the upper hand. It's not a buyer's market. It's not a seller's market when it's a normal market. A normal market means it's fair across the board. No one has the edge. With the less days on the market, meaning that we have under 4,500 single family homes available. That's that we haven't seen that for a while. The $425,000 and under of the active single family homes are 30% of the market for a number of 1,336 single family homes that are active that are 425,000 or under. Not bad. That's not bad, 30% of the active market. We listed 87 homes yesterday. It was the end of the month. Now, I was listening to a podcast today about the quarter one this year is probably the best time for sellers to sell. And why is that? Well, because they're going to get the highest price. That's what they're telling us because interest rates just jumped up today. Yes, they jumped up. And that's not good. It's not good for the buyers out there. So if sellers, that means buyers have less buying power. So if sellers want to get on that bandwagon, they should list their house in March because it appears by the so-called experts that quarter one will see the highest priced homes for the year. Now, I think that Vegas is always different. We're going to get into that a little bit later. But moving on with our stats, in February, we jumped up to 78 sales a day, 78 sales per day. And that's for Clark County. That's a big jump from where we were at the beginning of the year. So more and more people are buying homes. And again, this could be the time for your sellers to get on the market. The $1 million plus homes took a jump up to over 2.5 per day. I was kind of predicting that lightly. I said it was going to probably increase, and we may see that continue to increase. We shall see. When I looked at the stats on the price reductions, most of them are in the median price range, not the higher price ranges that you might expect. Let's see here. Anything else going on that is remarkable for today? Last year, we were selling 126 homes per day. We know that last year was just a stellar year, and we won't probably see that for a long, long time. I don't even know if we ever see it. The non-owner occupied buyers represent 30% of the market. They're buying 20 homes per day. Again, that could be second homes, that could be investment properties, and that could be people that just don't know what they're going to do yet, because the title companies get that information and pass it on to the tax assessor's records, and that's where we get our information. So there we are with that information. Now today, with the high interest rates, let's see, let's look at what happened here. Mortgage applications are decreasing. So according to data from the Mortgage Bankers Association, weekly mortgage applications survey ending last week, the measure of the application volume decreased almost 6% on a seasonably adjusted basis from 1 week earlier. So on the unadjusted basis, the index decreased 4%. Now, mortgage people talk a different language than we do, but basically what they're saying is that the 30-year fixed rate increased to 6.71 last week, and it just increased to 6.75 today. And that's the highest rate since November 2022. And that drove a 6% drop in applications. That was last week. So this week, when it just went up again, we're going to see this again. There was a revival in application activity in January because the mortgage rates dropped to 6.2. You see, it doesn't take much, right? It doesn't, hey, be happy, be quiet. Sorry. Anyway, so just preparing everybody, if people aren't applying for mortgages and that's dropping and rates are going up, you might want to be very vigilant on your marketing. And we're going to look at that in just a second. So anyway, don't know what to tell you here. Let's see if there's anything else remarkable. I videoed the website, so I wouldn't miss anything because this just came out today. But they said that the average contract interest rate for a 30-year fixed with conforming loan balances of $726,000 or less increased to 6.71%. Let me go back there. From 6.62, well, points increased from 0.77, from 7.75. And all of that means it costs more to get a loan, to buy down the rate, so on and so forth. So again, this is all mortgage talk. This came from the Mortgage Bankers site. So let's get rid of that for now. And excuse me, please. That's gone. And I wanted to show you some other things here today. Yes, the renter market overview. So what's happening now, of course, is that rents are cheaper than owning a home. And we didn't see that last year. So if you look at the Nevada market, we have a minimum wage here of $9.75. We have the renter who wants to to rent a 2-bedroom home needs to be making $21 or almost $22 an hour. And that would be those people that want, so let me put this side by side for a second there. The 2-bedroom hourly wage earner needs to be making almost $22 an hour. And when you, if you take that 2-bedroom and you take that $21 per hour, that's $3,755 a month. And of course, we want 3 times the monthly wage, the monthly rent to be what the wages are. So, yeah, that's right now. That means the rent would have to be $1,250. So the monthly rent of $1,250 means that person, if that's a single person now with a 2-bedroom home, would have to be making the $22 to be able to afford the 2-bedroom house with the rental rate of $1,250. So, and of course, if you have 2 people, that changes the game. And most of the people that we do rent to are families for the rental market of the homes. Yeah, the 64% of Americans, everybody, are living paycheck to paycheck. That was an astounding stat for me. I didn't think so, but yeah. And another stat that is interesting, and I want you to kind of absorb some of these stats because, you know, you've got to continue to market. You've got to continue to reach out to people. because you're going to have to reach out to more people to make perhaps the same number of sales that you need to make based on last year's your income level that you need to make for your lifestyle, for your household. So homeowners right now, this is really important. Homeowners right now, 2/3 of them have an interest rate of 4% or lower. Do you think they're going to sell? And do you think our inventory might go down? Now, I know I always say Vegas is a different animal. However, this is going to impact us. So people don't want to sell. They may, what you can do if people have to move or have to, they're going to have a baby. They've got to buy a bigger home or whatever. Make sure that you can articulate to them that they should possibly keep that home as an investment with that type of interest rate. Yes, because they can probably get a renter in there to pay the mortgage and maybe even have some cash flow. And the lenders are very amenable to someone buying a home and having an investment property, but you need a lease, of course. You need to have it rented ahead of time, which is usually pretty easy in the process. But anyway, we need to be thinking outside the box so that we start marketing. We have to market. If you don't market, you're not going to be out there. And it's more important than ever because people are not falling out of the sky. I was talking to some agents yesterday. They said, "Where did all the buyers go? I was paying for leads and now there's no buyer leads." Well, they're sitting on the sidelines because of the interest rates. And so a lot of these companies that were generating buyer leads aren't having a lot of success. I think I heard Realtor.com isn't, doling out the buyer leads like they used to. Well, they don't have them. That's why I suggested the other day, and let's put this back up here, that y'all join these referral sites. We still have people moving to Vegas. They want to rent, they want to buy, whatever they want to do. These 24 referral sites may be where you're going to get your next lead from. You need to have a good bio, a good picture. You need to be on the social media platforms. Facebook is where most of people are getting their leads for their business, not Instagram. Instagram isn't a lead generating machine like Facebook is, because Facebook gives you more opportunities to be out there. It's not such a static site like Instagram is. Lots of different things you can do on Facebook. Advertise the open houses. I was telling somebody yesterday, you better get a plan to do open houses. That's where buyers are, right? At open houses. Now, this is the season. This is not the season, but this is the situation that we're in. When you don't have a lot of buyers, you don't have a lot of people looking at those open houses. However, you are making an impression with the neighborhood. And so it's more than just the buyers walking through the door. It's the neighborhood people that see that you are out there doing what you should be doing, doing these open houses. And when you I was just a little hack here. Someone was saying today, when they put when a buyer comes into an open house, they say John Doe company buyer. And then, because they put that in their phone so that if they call, they know who it is. And then if it's a seller who's stopping by to see, they say, Sally Smith seller. And so then if they just type in seller in the search, all those sellers come up, which then they can, maybe they're going to do a seller campaign call or whatever they're going to do. But it segregates them in your phone. And John and I have been doing that for years. We'll put referral, we'll put buyer, we'll put seller, and a lot of times we'll put the date and or where we got it from. So in that company line on your phone, you can basically treat it like a database so that you can retrieve all those buyers, retrieve all those sellers. And then if you sell somebody a house, now they're a client. So you can put your client, maybe the date, their anniversary of their house. Anyway, use your phone as a database so that you can retrieve, not just retrieve people when you want them, but when they call, you know who it is and where they came from. Say, "Oh, Sally, you were in my open house and you live down the street. Are you thinking of selling, or you're going to keep that as an investment and maybe look around to buy another house? We have somebody right now that's doing that. So anyway, lots of little hints here and there for you all to hone in your business, because you're going to have to be sharp as a tack this year. Last year, remember, they fell out of the sky. Buyers and sellers aren't doing that this year. You're going to have to dig deep, right? We came from holding that butterfly net to having a shovel. So keep taking these hints and using them. Another thing I want to talk about today is mortgage deficiencies, because everybody always thinks, oh, the sky's going to fall. We're going to have that same thing that we did last year. So here's a friend of mine who did he did this podcast early this morning, and he's a banker, and he does a great job at explaining some things. And I'm going to put, let's see, I'm going to put this picture up here. And no, I don't want to do that. There we go. Okay, let's roll this and see. I'm going to mute myself.
Let's take a look at mortgage delinquency. This is another important measurement for health for the mortgage market. Okay, mortgage delinquency. Where are we at on delinquencies? Because a lot of people, when they hear some of this information that's coming out right now in housing, and oh boy, housing prices are going down, and demand is going down, okay, both which happen to be true. A lot of people who lived through 2004, 5, 6, 7, 8 are going to say, well, here come the wave of foreclosures. What does the data tell us? I'm going to read from CoreLogic. This just came out. CoreLogic reports that mortgage delinquency year over year have a 4 percentage point decrease. This will be available for you in the daily download below, so you can grab this. Okay, so December 2021 nationally, we had a 3.4% mortgage delinquency rate. December 2022, we're at 3%. Mortgage delinquency is improving right now. Mortgage delinquency rates continue to post some of the strongest performance in 3 years as we closed out 2022. As a healthy job market helped borrowers remain current on their payments, high amounts of home equity cushioned these borrowers who were far behind, keeping them from moving into foreclosure. While there was a small uptick in early stage delinquencies and foreclosure inventory over 2022, other delinquency measures fell to new lows throughout the year. It's a principal economist for CoreLogic. Where are some of the markets where delinquency might be higher than the national average? Mississippi at 5.7, Louisiana 5.6, West Virginia 4.5, New York 4.2, Oklahoma 4.2. Annual change in overall delinquency rates in those markets are all down, and Louisiana down the most at 1.1. Okay, 30 more days or more delinquent nationally in December 2022, 3% were delinquent by 30 days or more. Okay, so that's that number that we gave you there at the top. That's that 0.4 percentage drop. Okay, so despite this, though, 17% of U.S. metros did see increases. So that's what we're going to be looking at here. Those 17% of U.S. metro areas that posted increases from December 2021. How does that start in 2023? Okay, how does that roll over as we go into this year? And will we see more U.S. metros join that? We're coming from the bottom. Okay, we're coming from the bottom. So we expect an increase right now. Okay, we would be foolish not to expect some type of an increase. Okay, especially if the job market gets disrupted. That'll be the biggest mover on delinquencies. If the job market gets disrupted this year in a big way, if the Fed has their way and they get to lay a bunch of people off to make their job of fighting inflation easier, that's where we're going to see some of these numbers pop up. But we're coming from historic low numbers. So people that say, hey, I'm waiting for all these foreclosures, you'll be waiting a long time. Even if that happens, there's a lot of time for foreclosures to start coming onto the market. We wouldn't really see anything significant, even if we had catastrophic job loss this year, until 2024. So if investors are telling you they're waiting for these foreclosures to rush the market here in 2023, not going to happen, showing this data. Tahar says, what are your thoughts on the trend in agencies offering content without knowing what they are doing? Trend in agencies offering content with, give me an example. Not exactly sure where you're going with that. Okay. December's 1.2% serious delinquency rate, so that's later on in the process, has barely moved since last spring, which suggests that while some borrowers may have missed several payments, okay, so you can miss a few payments and they're going to give you some leeway basically, most are likely to recover relatively quickly. That is an indicator of the strong job market. But again, you get a real issue with the strong job market, then you're going to see some of these numbers increase. Okay. Also down below in the daily download, I put this chart. We've got 380 metropolitan areas where serious delinquency rate decrease, serious delinquency year over year change. You can see that basically you've got really nowhere in the country that should be worried about serious delinquency rate. Okay, so some investor tells you, hey, I'm going to be capitalizing on these opportunities. Show them this chart, show them the data, let them know they will be waiting deep until 2024. Okay, I'll have that whole entire CoreLogic study linked down below if you just want to grab that and read through. But that is your update as of right now, as we sit here March 1st. Mortgage delinquency down 0.4% year over year. We've got 17% of metros that are up. We'll watch those closely as the year goes on to see how much they go up, but we're bouncing off of historic lows. Okay. Yesterday we had a couple of
So let's just concentrate on this for now. Oops. This is really an important chart because, again, if you have investors out there that think they're going to wait, don't tell them not to wait. Maybe wait till the second quarter, because as we talked about earlier, the best prices are going to be the first quarter. So be the person who has the knowledge to tell the investors, let's wait till, maybe May or June. We'll start looking now. That let's see when the prices may drop a little bit. Now in Vegas, again, you never know about us. We're different, and we're different because we have a strong job market. We have 600 events coming this year. We talked about the other day. We have Formula One. We have, the Super Bowl coming next year. All these things and all the infrastructure that Boring Company is doing. I mean, we have so many things that are creating jobs. So, and we don't have enough people to fill all the jobs. So again, I don't see that we are in any kind of a bubble at all. And remember, I said earlier that 2/3 of homeowners have an interest rate of 4% or less. Now, what you can glean out of that, just a side note, go after the people that have the higher ones. Okay, go after those people to perhaps move if they want to sell. It might be the best time for them to sell. Anyway, just think about how the numbers can help you in the reverse direction. But 2/3 of homeowners have interest rates of 4% or under. Now, those could be potential investors because they do need to move. So there's a lot of moving parts here to this market. When markets shift, and 3 times a week, you see the different trends and how they're shifting in the past, every day something different happens, it seems. With interest rates, with new events coming to Vegas, we have a very shifting market, but we have a solid market. And if you look at where I have the arrow here, the big arrow says -1 to -2 percentage points of change in delinquency year over year. And of course, there is where we're located in Clark County. I mean, the proof is there. And then you have these little arrows that I put. These are the places that are in trouble. Yeah, there are 4 metropolitan areas where serious delinquency rates have increased. And that's in New York. And then down there, it looks like right above Naples and Captiva, right in that area, they've had a lot of foreclosures. Well, prices went up pretty high down there. Yeah, they did. Anyway, there's 380 metropolitan areas where the rate decreased. So 4, they increased, 380, they decreased. So I don't think we're going to have any kind of a massive foreclosure market anytime soon. And he did say that if there is a job shakeup, like if people start losing their jobs, that may affect the foreclosure market. Things might increase, but we're still at record lows. So even if it does increase, it's not going to increase perhaps like we were thinking in 2006, 7, 8, in those dark years we had. Okay, so I think we're looking pretty good here with that. And with that said, I said earlier, if you don't market, if you're not out there marketing, people are not going to know you. If the tree falls in the forest and nobody's there to hear it, did it really fall? That's kind of something to say. So let's talk about what you're doing just to wrap up the show here. I've got like 3 more minutes. The fact is, most of your followers won't see your next post on social, maybe 10% at best. And why? Now, for years we were teaching social media and we were telling people, I don't care if you spend $1 a day, $5 a day would be what we recommended, but boost your information, boost your website pages out there, boost the home of the day out there. Whatever you do, start spending money, because these bigger companies, they're not, you're just going to get lost in the feed, because everyone else is publishing content and all the feeds are traffic jammed, if you can think of it like that. So that means whatever call to action or important message was within any given post is lost on 90% of your audience. So on the flip side, it's poor practice to drop a straight up call to action in every single post, right? You don't want to become obnoxious. You want to sell your house today? Call me at 555. No. You'll get unfollowed if you do that. That's not good. You don't want to do that. So the fact is, what's your best? Let's talk about what your best course of action is. Introducing the dog whistle calls to action. Now, what is that? What do you think of a better term? So if you've got a better term, let me know. Any coded calls to action, whatever. The dog whistle describes a call to action that's only heard by those for whom it's intended. Everyone else, it's unnoticed because it's subtle. So maybe a point that appeals to a frustrated seller or buyer who's unaware of alternative financing options and thinks they're priced out of the market, that might be a point to do a boost about, do a short video about. And Facebook stories get a lot of action. Now, the problem with the stories and the reels is they're gone. Okay. So you need to do something. That's why we say every day, do something, spend a little bit of money, get your voice out there so that you start showing up in the feeds, because the people that are paying the money are the people that are going to show up in the feeds. And the pain, and talk about the pain points that your clients are having. Sell endlessly without ever sounding salesy. And so I think that this particular fact is something that you need to use. Nothing happens if you're not marketing. Nothing happens if you're not marketing. So get out there and do some marketing. The other thing today is, how do you leverage Google to attract in particular listings? Well, if you want more listings, the market belongs to those who market. I just said that. You got to keep on marketing. You got to keep on positioning your business to win opportunities, to win the consideration of everybody in your database and everybody in your marketplace who's looking for the best realtor near them. So let's talk about the best realtor near me through the lens of the consumer. People search about all kinds of things, right? Well, here's something that perhaps would inspire you to know. Of all the weird searches that happen in the entire space of Google, what percentage would you say are of local content? So what I'm saying is, of all the people in Google that are searching, 46% of all Google searches every day are conducted with local intent. So do you have your Google business profile done? Are you uploading those listings and the products so that you can start getting some traction to your Google business page? If you zoom back a second and ask the question, what is the value proposition of Google? Well, is there actually any search volume for realtors? You think that people aren't naturally programmed to go Googling for the best realtor near them? But it happens in a surprising amount. There's 4 billion local searches, and there's a large cross-section of people that are looking for you on Google. People are looking for you. And of course, I say this all the time. We live in Vegas, so people don't know everybody here. So they Google it because they're coming here from out of town. So this is a perfect place for you to attract people. And so just remember, I'm going to go back here and remember this. The market belongs to those who market. So and I'm going to be doing a lot of nudging here the next couple months because I'm worried for you. I'm not worried, not the right word. I'm concerned for you because if you're not doing the right things, you're going to miss out on. Right now, what are we doing? 78 sales a day. So there are buyers here. There are buyers here. Not as many as there were, but it doesn't matter. The people that are marketing are going to get them. So start marketing. I love you all. We have a class coming up on Friday. It is a great class, and it is about contracts. And let's see here. Let me hide this real quick and put this up here. Yes, so we're having the contracts. Do you know all the contract disclosures and understand their importance? Again, when you take these classes, everybody, think of how you can. I mean, we always ask questions in class. We always almost always pose case studies. And these case studies, for the most part, came from real life situations. So we know that the consumers, as buyers, as sellers out there are asking these questions and may have concerns about something that the class is about. So not only are you getting your CE and your core credits, thank you. Appreciate that. Thank you, Ruthie. Great info. Love that. Appreciate that. Anyway, I really do. I'm really concerned for everybody, and I really want to try to help us navigate the next couple months. Come to the class. You'll not only get the credits, but you'll get information that you can go out there and use in your subtle marketing. Not can I sell you a house? Can I sell your house? But so what you want to do is give people good information. And that way you attract your tribe, right? Your vibe will attract your tribe. Don't forget that. So if you're not out there marketing, you're not going to get any buyers and sellers, and it's going to get tougher. So the tough, what happens, when the going gets tough, the tough get going. And so we need to do that. 10 to 1 on Friday. Jimmy's teaching it. It's a fairly new class, and he tells us why all these disclosures are so important. So this gives you so much information to go out there and use in your social media marketing as well. Again, what we were just saying is make yourself known and do those videos, do a 30-second video and then upload it to your Google profile about something you learned in the class. And there's 3 hours of information. Anyway, I love you all. Hopefully you'll go to be.vegas and sign up. We've been having record numbers in our classes, which is great. We always have lunch, and it's only $20. And if you buy the bundle of 6, you get you get 6 for the price of 5. So I love you all. Thanks for putting up with me, and give me a like or a love or subscribe to my YouTube channel. And we've been without a videographer for a couple weeks, so we haven't been uploading our videos, but I think Kane has found